Hello everyone and welcome to a new edition of A Chat with Daman Asset Management team. Sentiment is set to remain cautious into the end of the year. While high yield on aggregate lagged investment grade less in October versus September, we believe a key driver of this is the underperformance of the crowded overweight trades such as Egypt, Ghana and Argentina. More broadly for high yield, the flow is suggesting a general underweight and a trend to fly back to quality. Our focus is to close the year protecting our performance while avoiding any distressed story and perhaps adding some few investment-grade issuance that may still come through. Having said that, we still see pockets of value in the high-yield space, especially with Ukraine and Bahrain. Neither have been among the key underperformers in the single B space. Bahrain posted a strong performance, only lagging Oman, which is also one of our top holdings, yet both of them have a lot of scope for improvement on the domestic front. Ukraine reached recently a staff-level agreement on a new IMF tranche worth $700 million, expected to be disbursed in November, and received 600 million euro from the European Union. With the budget results also coming in beating expectation, the financing outlook looks much brighter. In MENA, tight spreads for Saudi Arabia forced us to reassess our view and we assigned a neutral stance to the country. We think the hydrocarbon story has been well communicated to the market and investors now will shift their focus to the Vision 2030 and the more recently introduced Green Ambition Plan. The most immediate consequence of this is a supply risk in the public and private sector, alongside a renewed IPO momentum and an overhang from a potential return of Saudi Arabia to the market, which ultimately could widen the spread further. Generally, it's worth noting that investment grade still looks expensive on a relative rating basis, of course, across all the regions apart from Latin America. The region is suffering from global shift to tighter financial conditions which have weighted on risk appetite. Regional inflation has surged above the target range in Brazil, Chile, Colombia, Mexico and Peru. These countries have had to accelerate their tightening cycles, in some cases to a pace not seen in 2 decades, like Brazil, and all of this despite concern over still fragile recoveries. On the other side, social pressures and economic elections, with key elections coming up in Brazil, Chile and Colombia, have made the withdrawal of COVID-related measures more challenging than expected. Elsewhere in Asia, forecasts were sharply downgraded by the IMF on the back of COVID resurgence, slow vaccination rate, and slower than expected recoveries. Only South Korea exhibits a strong recovery backed by strong high-tech experts. Most of the downgrade is coming from low-income countries such as India and Asian countries, which carry the biggest risk of virus resurgence, while firstly, outlook for tourism remains subdued, affecting mainly Cambodia, Laos and Thailand. And second, the policies remain very constrained. Vietnam outperformed regional peers with relatively effective containment measures, yet the 2021 wave severely dragged down the country growth. Despite the persistent damage from the pandemic on the labor market and production capacity, we think Vietnam should continue to benefit from its successful integration in the regional manufacturing supply chain and the global good demand recovery in the medium term.
As widely expected by the markets, the Fed announced tapering of its asset purchases as it achieved the substantial further progress towards its twin goals of maximum employment and inflation averaging 2%. On inflation, it acknowledged that higher prices could persist for longer. However, it still insisted on inflation being largely transitory. Chairman Powell, during his speech, segregated tapering from rate hikes and mentioned that rate hikes would need to meet a more stringent test of maximum employment. We believe with COVID cases going down in most parts of the world and progress on vaccinations, supply chain issues should subside gradually with increased availability of labor. As a result, post a slowdown in third quarter, we expect global economic growth to rebound in fourth quarter and remain above trend in 2022 on strong pent-up demand and increase in business investment. Hence, we continue to advocate an overweight on equities with a tilt towards value style and cyclical sectors. In the near term, given the supply chain issues and high inflation, it is important to be more discerning. Hence, we recommend a well-researched bottom-up stock-picking approach to identify companies which can successfully navigate supply chain issues and pass on the higher prices. We are neutral on US, but would play the market through overweighting cyclicals and top big tech names and underweighting long-duration tech names. We keep our overweight on Europe, given its valuation discount versus US and cyclical tilt. We maintain our neutral stance on EMs as EM central banks remain under pressure to respond to rising US yields, higher inflation, and depreciating currencies. Within EM, we like an exposure to countries which have the firepower to steer through such headwinds tied to their strong foreign reserves, low external debt, and improving current account balances. We like an exposure to South Korea, Indonesia, Thailand, and India in Asia, Saudi, UAE, and Qatar in MENA, Russia in Eastern Europe, and Mexico in LATAM. Asian economies would benefit from an acceleration in economic reopening on higher vaccination rates and lower case counts. Strong year-on-year rise in energy prices should underpin GCC, Russian, and Mexican equities. Given the commitment and announced visions of most GCC governments in terms of increasing non-oil sector contribution to GDP, we see a strong economic and earnings growth story in the midterm. Such commitments will be backed by the government's ability to fund projects via considerable accumulated reserves, asset sales, and incentivizing private sector investment. There has been also a strong push to reflect economic wealth on capital markets by listing key GREs and encouraging private companies to list. We see a strong IPO pipeline supported by improved liquidity and relaxed listing requirements. Dubai recently announced a plan to list 10 state-owned entities on DFM exchange and a $550 million market-making fund to increase liquidity and market depth. We reinitiated a position in Jazeera Airways in Kuwait. The company has an astute management team, strong promoters, and is well positioned to benefit from the full reopening of passenger traffic at the Kuwait International Airport and huge pent-up demand for travel. The airline also has a plan to double its fleet in next 5 years. We initiated a position in Commercial International Bank in Egypt. The bank will be a key beneficiary of increase in credit growth linked to an expected commencement of capex cycle in 2022. The stock remains undervalued, trading at a 1-year forward price to book of 1.5x with an expected ROE of 21%. On the dividend yield side, we increase our exposure to ADNOC Drilling due to the company's stable free cash flow generation outlook and well-communicated dividend policy, and also to ADNOC Distribution due to the company's strong growth in new stations rollout and improvement in volumes on economic reopening. Thank you for taking the time and watching another edition of a chat with Daman Asset Management team. You can always contact us on our website and social media platforms. Till the next edition.